Okay, today is the 7th of November, 2019, marks our first introductory fundamental Thursday. So we're going to kick today off with a few topics. One in particular that I will go over is the current situation with Brexit. Now, as you may all be aware, we have, of course, been in a situation where last week, if not 2 weeks ago now, we was meant to have a Brexit decision on the 31st. So yes, that would be last week on the 31st of October. We was meant to have a decision on Brexit. As many know, this has, of course, now been delayed and pushed back to January with an extension. And today, with the pound interest rate also being released and maintaining at the same level, we can now start to see a slow but steady decline in the faith in the strength of the Great British Pound. Now, with that being said, what we have a look at today, with Mark Carney speaking, was actually two of the other officials who were part of making a decision to either increase or decrease, or of course keep the interest rate the same. There were two members that actually voted to decrease the rate. So it does look like over the next coming month, of course, when we go into November and we see the next interest rate, we should really start to see a slow decline in regards to interest rates. And ultimately, interest rates equal value for money. Okay, the more interest the banks are giving you, the more value for your money they're allowing you to make. So very simply, the lower the interest rates, the less value they're given to us, which of course should mean and does mean, okay, the lower interest rates usually becomes the higher people spend. But of course, in this generation right now, you've probably got a mixture between savers and spenders. But how it does usually go, when the interest rates are low, spending is very high. And the reason why spending is very high is because the interest rates don't attract you to save your money. But when the interest rates are higher, of course, it's more attractable to save your money, which is why money, of course, goes into savings accounts such as bonds, ISAs, etc. So right now, and of course, you guys may have heard about the financial, I wouldn't say crisis, but the financial problems Metro Bank has been going through. They put out a fundraiser, and they struggled to raise £300 million in bonds. So that again should show you that in regards to the banking side of things, financially, they are they are decreasing in terms of the amount, their size, their value. I mean, I'm sure you've seen it globally. British banks are closing down stores. Everything's becoming more online. So we are now starting to see a reflection in the price of the pound. We have seen, of course, a very nice surge in regards to pound reaching the heights of 130. And of course, in light of the Brexit, we have, of course, seen the pound slowly decline and consolidate, which, of course, we could in turn actually see the pound still flourish. But due to the uncertainty of Brexit, due to even Mark Carney, okay, he's the chairman, the governor of the Bank of England. Now, his reign actually comes to an end in January. So again, with the and at the moment, the pound, the British economy have not actually found a successor for Mark Carney. So with them not actually finding a replacement for him, again, this does overlude the fact that there is a massive uncertainty bubble around Great Britain at the moment, because very simply, there isn't really things in place to show us where we're going. And if we don't have any tracks in place, it's hard to kind of visualize what the potential outcomes could be. And that's why at the moment we're seeing the pound fluctuate. Amongst its within its consolidation, the pound is still fluctuating. And in light of the news we've had today, the interest rate is remaining the same. They do want to slow down quantitative easing. But with all of this being said, of course, if we come into a situation where we don't tie a deal with the EU, we probably could look to see more money being printed. But at the moment, the biggest downturn will be not coming out of a deal with the pound and the euro. If they do not strike a successful deal, this will only make the pound more strenuous in regards to, again, interest rates going lower. And more importantly, for the everyday, average Joe who's working a 9 to 5 job, what this will often mean is the cost of living, which is inflation, will increase. And with inflation increasing, things will get more expensive. Your pint of milk, maybe a bus ride, right down to the clothes that you probably buy in terms of underwear or sweets from a convenience store. Very simply, right now we are in a unknown territory in regards to one, our prime minister, he also wants to have an election. Now, this election is actually conclusive to the Brexit decision. And the reason why I say that is because what he's hoping for is to get a parliament that will have majority vote for Conservative, which will allow him to then strive on and, of course, close a deal with the European Union. However, if we do get a what's known as a hung parliament, which could be a 50-50 split, okay, that would, of course, then delay Brexit even further and actually could result in a more dramatized economic downturn than what we're currently facing at the moment. So again, I go back to the word uncertainty. There's a lot of uncertainty around the pound, around the Great Britain's economy, and for that reason, we have to keep our ears open, keep our ears up and our eyes wide, and just staying alert to what's going on around the Great British economy at the moment. That concludes my wrap up on the Great British Pound, the British economy. We will keep you updated. And now I go over to Adam, who's going to take you through the Australian market.
Hi there, guys. Today I'm just going to go over the Australian interest rate decision we had earlier this week and a few things we can expect now within that currency and how this may affect the market now that we are coming to the end of the year. So Australia kept its interest rates unchanged on Tuesday, which had something to do with the property prices that will increase household wealth and confidence in consumers. This will basically mean that people are more willing to part with their cash, and people being more willing to part with their cash is always a bonus. The cash rate remained the same at 0.75% in Sydney, and this had three contributing factors since June. The decision was predicted by money markets and economists and is becoming a struggle for the Australian dollar to accelerate their economic growth and rekindle inflation. It is reasonable to expect now that there will be an extended period of low interest rates will be required. The board is prepared to ease monetary policy further if needed to support sustainable growth in the economy. The Federal Reserve signalled last week it was pausing rate cuts. This is highly likely to slow upside movement. Housing prices in Melbourne surged 2.3% in October, the biggest monthly gain in almost 10 years. Sydney isn't far behind, advancing 1.7% last month. All these bonuses and advantages in the housing have not, however, improved the sentiment in the Australian dollar. The low level of interest rates, recent tax cuts, ongoing spending on infrastructure, the upswing in house prices in some markets, and a brighter outlook for the resources sector should all support growth. As has been the case for some time, Australia's economy is being supported by one of the fastest growing populations in the modern world. It is providing a problem for the jobs market, where a surge in hiring has been mainly met by new entrants to the labour force. This has been keeping unemployment above 5%. The governor is trying to push down the jobless rate in order to raise the wage growth, which will then revive inflation. Offshore key trading partner China continues to slow, and instability from Brexit to Hong Kong is weighing on global growth. The bright spot is increasing signs of a preliminary US-China trade deal on the horizon. So to summarize this info and dissect it, basically, we could be looking at a lot of downside movement regarding the Aussie pairs, providing the housing circumstances and the inflation stay the same. So be sure to keep up to date with this information. Follow the videos we post in Telegram and follow us on Instagram at litcapital_. And I will now pass you to Jacob, who has some valuable information on that US-China deal.
Hi then, guys. So I'm just going to add to what Adam was going off with the US and China trade war. So China and the US have actually agreed to roll back tariffs on each other's goods as they work towards actually striking a deal between both parties. Top negotiators have had constructive discussions this week and have agreed to remove the additional tariffs in phases as progress is made on the agreement. Both countries should roll back existing tariffs in the same amount. This is an important condition for reaching an agreement, as it's one of China's key demands, as the tariffs now apply to the majority of the exports in the US. The two sides will continue to negotiate over the Phase 1 deal, and whether it will be signed, there's been no information on if it will take place. The Trump administration officials in recent days have expressed optimism that Phase 1 of the comprehensive deal might come together this month. This has helped boost equity markets to records this week. Stocks have rallied with the Hong Kong's Hang Seng Index climbing by 0.6%. European shares and US stocks also jumped. The looming question marks right now is what the two sides have actually agreed on and how the US will react to China's tariff remarks. The two sides continue to negotiate when and where Phase 1 will be signed, as there's been no information. Given repeated reversals in more than a year-long trade war, investors are now waiting further for confirmations on progress between the two sides. This concludes the Fundamental Thursday. We will continue to provide updates on exclusive content to our students and monthly content to our subscribers online. Be sure to look out for our website coming soon. Have a great day.